It is the 31st of July, and this is Market Truths. What are truths? Truths are facts, and what are the facts? The facts are the market's in a shitstorm. But we knew it was coming. We knew well ahead of time, did we not? And we saw all classic examples of the stairs stepping down as we look to the book for charting, and we can see that these are falling three methods. You can go through these and count them out yourself, but they are clear as a bell on a 5-minute S&P chart. And moments ago, we were looking at PBR. That was setting us up here for failure, unless we were only going to trade for a couple of cents, because as this was going up, it still was setting up a falling three methods, and this was in a overbought condition, so we knew we couldn't hold it for long, if at all, if we decided to bother. We have an example of owning options and writing options for the time premium. And over a 20-year period, which many people have just held their accounts for 20 years, and instead of writing options, instead of making $1.7 million in time premium, they settled for $300,000. So why is the market down? Market's down because of price. How do we know that? Well, let's look at the news. And here now the news. Remember who said that? Howard K. Smith. And here now the news. Here it is, Boston and London, Business Wire, Pioneer Investments, a leading global asset management firm. Print it out, read it all you want, read all the headlines you want. There's millions of them. You will have to return to the chart because this is all noise. Selling news, situation. But it doesn't matter because the market truths are specific. The market truths are simple. The charts don't lie. The charts are based on facts. Facts of buyers and sellers. Well, this is a chart of the S&P 500 3-minute, 3-day chart. We're looking at resistance right now at the 8-day moving average and a back test with the stochastics after a crossover. Another bull trap, perhaps a bear trap. Count them out. Take a look at the highs and the lows and make your predictions. But here's a great prediction. Let's take a look at the S&P 500 on a daily chart. And we can see these two cyan lines dating back to 2011. 2011, and I drew this chart in here because why? It broke above it. Now it certainly has fallen. Lost the 20-day moving average, lost the 50-day so far today. We'll see how it ends. But this is the top part of the channel, the cyan line, and it has pierced into that. So will it continue downwards all the way to the bottom channel like it did here, forming this beautiful morning star pattern, and then rise to the top of the channel, forming a evening star pattern, which is not perfect. But again, this chart did not read the book that's in the library that sits on a shelf 24. Maybe it read it here. Beautiful morning star pattern at the bottom of the channel. Where does it go? It goes to the top of the channel. If you want to argue over price here, it does not matter now, does it? Because sooner or later you would have been out here, and so you would have had to sit and wait. Folded hands. Follow this back in the videos of last year, October and November. Same channel. Another morning star pattern. Look at that beautiful evening star pattern. Perhaps it did read the book. Perhaps I am wrong. We'll have to check the news story and the news wires to see what happened then. But it doesn't matter. Check the news wire all you want. You're still going to come up here and find this. And you're going to find this and this. An oversold condition. An overbought condition, excuse me. I'm upside down. And here we are, oversold, making a beautiful morning star pattern. And this goes back to October 9, 2013. How can you do it? Well, it's in the charting, not in the news, because these are the facts. And what are the facts? The facts are market truths. Hey, I couldn't resist. This is showing 450 days on a daily chart. That means each candle represents 1 day. And we are showing 450, bear flag all the way back to it's not a beer flag. We're not going to drink the flag. A bear flag, 2012. And we see it finally got up into this channel after falling out of the channel. And right back in there, and look what it found. It found support. Where did it find support? At the bottom of the channel. We can see that by the Morningstar pattern. Morningstar pattern. Look at it. There's another one. And just follow it all the way up. And why aren't you trading? Why didn't you make it simple? This is a simpler method, is it not? Look at the RSI. Tell sign. Remember the lady on Channel 8? She used to say, she'd draw a flower and say, "Isn't that fun? Isn't that fun?" And look at this. We just draw these little stair steps all the way down. Have fun with it. Okay, so you reviewed the S&P 500 chart, the high and lows of the channel. And throughout the course of 25 years, if you wrote options against your stock, let's say you owned this stock and you wrote this option yesterday because of the high of $1.52. And we'll just use this example. It doesn't matter where we start because we can also go into the put options and write a put against it, and we can come up with whatever calculation we want. But to be conservative, we'll just take this from 4,000 shares, which would be 40 contracts times 100. Just $1.52 times 4,000. And you have $6,000 for the month times 12. 72,000 for the year times 25 years. And you got $1.8 million. Okay, you divide it out any way you want. Let's knock over $800,000, and so you're down $1 million if you did not write options. Instead of 1.8, let's just say you lost $1 million. You didn't make $1 million. And if you had to put options into that over 25 years, and then you take the simple interest of doubling every 10 years, it's a huge sum of money compared to 300 grand against $1.8 million. You could have made 5.5 times more money writing option premiums and then add your interest over a 25-year period. So take 1 year, take 1 month. It doesn't matter. It's time premium credited to your account. Let's do it backwards. Let's start writing put options. And today would be a good day to write put options because the stock is down $2.80 right now at 147, so 100.5. So if we just looked at the 99 option at $1.23 is the midpoint for $1.37, you probably get it for $1.30. 130 times 4,000, 40 contracts times 100 is 4,000. Times the $1.30 is $5,200 into your account because magically you either sold the stock or the stock got called away. Oh my goodness, what will I do? The stock got called away. Well, you just made $1.30 in your account and you don't even own the stock. Now, what if you did that times 12 months? 62 grand for the year and you still don't own the stock. Why are you buying the stock when you can have the time premium? See you on another day.